Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is November 11, 2024, and it is a weekly markets update. Let's have a look at the news of week 45 and see what are the next trends. Indian Urea purchase tender that will close today didn't support slipping prices, especially West of Suez. Also, during past week, the gap between FOB prices East and West of Suez deepened. This is a result of continuing subdued demand in Europe and Latin America, as well as confidence of Middle East producers in their sales through the second half of November at least, which doesn't push them to correct prices downwards immediately. In Europe, buyers are very cautious with new purchases. And even the announced stoppage of Ferrara plant in Italy, producer of 600,000 tons of urea annually, for maintenance until January, didn't provoke uptick in demand. There are discussions that next round of purchasing might start when FOB price level in Egypt will reach $350. At the moment, offers circulate around $360 to $65 FOB, so still at least $10 difference between buyers and sellers' sentiment. No significant sales from Egypt were concluded during past week. Activity in the Black Sea was subdued with no major deals. SOCAR recent tender for significant volumes didn't attract any interest. And the level discussed at the moment is as low as 300 mid-30s FOB. Demand in Turkey hasn't picked up yet. However, low international values might help in upcoming weeks. Iranian material was proposed at around $350 CFR duty unpaid, but perhaps offers will slip taking into account lack of sales during past couple of weeks for Iranian producers. In Iran, producers Lord the Gun and MIS are expected to close sales tenders for more than 140,000 tons of granular urea with target of $325 FOB. However, market rumors say that this level is definitely not achievable. Even $310 FOB will be difficult to sell at the moment. Other Middle East producers were sitting and waiting last week for the outcome of the Indian tender. Being quite comfortable with the sales lineup for November, they are not in a rush for any immediate spot sales. However, it is clear that spot levels achieved earlier in $370 FOB level are not realistic anymore, and any fresh sales will perhaps happen not higher than $360 or even lower. Demand in Brazil is still lagging behind, and CFR prices are additionally pressured by ample volumes floating with no liquidity in other markets. Last week offers dipped as low as 355 CFR, and level of 350 is widely discussed, which is $20 lower versus a week ago. Demand in other Latin American markets was rather quiet. The only activity is in coffee tender for supply of 33,000 tons of prilled and granular urea in total to different Central American ports for December. It will close today. In the US, the activity was minimal, with barges sold at NOLA FOB for November as low as $308 to $10 level. In Africa, Ethiopian Agricultural Business Corporation, EABC, announced a tender for 200,000 of granular urea to be shipped through mid-January. The tender will be closed on November 19. All recent shipments took place from Middle East, so we will see which volumes will compete in the tender now, taking into account Indian tender happening at the same time. Paper values dropped dramatically for all benchmarks, in line with bearish sentiment across the geographies. Egypt FOB dipped by more than $10 for November and December to the average of $365 and $350 respectively, while for January the market expects uptick to the level of $365. NOLA FOB also corrected downwards significantly to the average of $313 for short ton for November, $315 for December, and $320 for January. Arab Gulf FOB slipped to average of 358 in November, 345 in December, and 350 in January. Brazil CFR dropped to the average of $350 for November, December, and January. Ammonium sulfate market prices are under pressure due to significant downward corrections in global nitrogen prices in general. However, strong fundamentals don't let the price decrease dramatically. In China, standard copper grade supply is limited through November and partially December, so producers don't decrease prices more than a couple of dollars. Last week, FOB level was in the mid-130s. However, granular values in the markets of final destination, such as Brazil, might drop more due to bearish trend in nitrogen that will negatively affect profitability of Chinese competitors. In Brazil, buyers were checking the market for CFR price in the mid-160s, while latest deals were done in the mid-170s. However, no firm deals were concluded. At the same time, there is certain activity in Central America, wherein COFA tenders for 5,000 tons of standard and granular copper product each to several ports. Plus, in Mexico, importer is looking for 5,000 to 10,000 tons of standard and 25,000 to 30,000 tons of granular product for December shipment. European price level remains mostly unchanged due to tight supply. Copper standard MSU was traded at around 180 euros FOB, northwestern Europe. Price idea for granular product was around 215 euros FOB, with very little buyer's interest. Bearish sentiment in urea stimulated European buyers to step back from nitrates purchases and wait for more clarity. Prices for both AN and CAN in Europe drop across all markets with no liquidity. Same tendency is obvious for UAN in Europe. In Brazil, there is seasonally no demand for ammonium nitrate. Ammonia market prices moved in different directions, west and east of Suez. West of Suez, price for CFR Europe firmed to $600, first time since December 2023. This happened due to tight spot supply from Northern Africa and the Americas for November shipment, while some stocks are depleted. East of Suez, prices have fallen by $5 to $15 to the level around $450 to $65 CFR. Improved availability with Marden being back on stream keeps prices on the low end. However, spot availability is almost non-existing for November and partially December. Demand in India continues to be strong, but buyers are reluctant to pay current levels, with availability improving in the region. In the US, autumn application approaches, but at first demand will be covered by ample stocks. Some purchasing activity is expected at the end of November, beginning December. In phosphate segment, the demand remains vivid only east of Suez. In India, demand is still strong amid significant shortage of supply this year. Last week, 110,000 tons of Marden product was purchased by a group of Indian importers at $635 CFR for shipment in November. Additionally, about 30,000 tons of Russian MAP was purchased by RCF at around $680 CFR, also for shipment this month. Bangladeshi government issued another purchase tender for DAP and TSP, closed yesterday, with no results available yet. However, payment problem that was the reason for scrapping several previous tenders still exists, so there is no clarity how this tender will move forward. Ethiopian ABC started rewarding its tender. The rumors circulate that by now 400,000 tons of DAP are awarded, mostly from China, and more negotiations with Chinese suppliers are ongoing. We will see the final result perhaps this week or maybe next week. Because of these sales to Ethiopia, Chinese DAP prices climbed to $610 to $20 FOB. Most Chinese producers are halting offers for the rest of this year in order to gain clarity from the government regarding export regulations for 2025. So with all these events and continuing strong demand from India, DAP prices are expected to stay elevated in Q4 this year. In potash segment, news emerged from Belarus, where President Lukashenko instructed the new director of potash producer Belarus-Kali to consult with his Russian counterpart in order to discuss price increase for potash via production cut of 10%. He indicated that current price is just at the level or sometimes lower than Belarus-Kali costs, thus needs to be revised. Moving to the fundamentals. Of course, the most important news of last week was elections in the US and new old president coming back to the White House. There are many discussions regarding policy changes that are expected to take place during Trump's presidency, including potential tariff wars, growth of domestic production of oil and gas, and also massive exports of these resources. That will be a game changer in the global market. But I think let's see some actual steps first. However, what immediately changed in hours after Trump's victory was dollar strengthening against major currencies. Further dollar rally depends on if investors believe that Trump indeed puts in place tax cuts and tariffs that are the part of his economic platform. A rising dollar could be a double-edged sword for the US economy, helping tamp down inflation while hurting the competitiveness of American products abroad. It could also pressure the profits of multinational US companies that need to convert their foreign profits into dollars. So we will watch the situation developing after January 20, after the inauguration. European natural gas futures rose above 42 euros per megawatt hour and are on track for a 9% weekly increase due to colder weather forecasts and reduced wind power expected next week. This would increase gas demand for power generation, prompting more withdrawals from storage, which is currently 94.4% full. Additionally, markets are considering potential impacts from Trump's victory, especially his position on Ukraine and LNG export projects, which could affect future supply. US natural gas futures fell below $2.7 per MMBtu on Friday due to forecasts of mild weather through late November, which is expected to keep heating demand low and allow utilities to inject more gas into storage. According to analysts' evaluations, average gas output in the lower 48 states has dropped to 100.7 billion cubic feet per day in November, from 101.3 in October, more than 4% lower compared to a record December 2023. Additionally, several energy firms have reduced last week oil and gas output from offshore Gulf of Mexico platforms in front of Rafael storm that finally hasn't made landfall in the US. Agricultural commodities future prices climbed amid fresh USDA report that was published on Thursday last week. Wheat futures slightly increased and stabilized at the level of $5.71 per bushel. The USDA projected US all-wheat plantings for 25-26 marketing year at 46 million acres, marginally below 46.1 million acres seeded this year. The report also noted that US farmers are expected to increase corn acreage while reducing soybean and wheat plantings for the upcoming marketing year. Meanwhile, Ukraine reported a wheat harvest of 22.3 million tons, affirming that winter sowing targets for the 2025 harvest will be met despite difficult weather. Additionally, high Ukrainian wheat exports have added pressure on prices, as grain and oilseed exports by sea and river reached 5.3 million tons in October, up almost by 70% versus a year ago. Corn futures climbed to $4.31 per bushel, almost reaching the highest level since beginning of July. The USDA reduced its US corn crop projection by 60 million bushel from last month, which is 1% lower than last year. The report left the US acreage projection unchanged at 82.7 million acres, while slightly decreasing the yield. In addition, ethanol use was unchanged at 4.45 billion bushels. Ending stocks are projected to decrease both in the US and globally. All these factors drove future price increase. Soybean futures rebounded to $10.17 per bushel amid new valuations in USDA report and also expectations related to Trump's victory. In the USDA report, soybean production was reduced by 3%, or 121 million bushels, which would still be a record high. Yields were cut to 51.7 bushels per acre, while acreage was unchanged, but still 5% higher than in 2023. The smaller crop was, however, predicted to trim US soybean ending stocks to what some analysts call a more manageable. From the other hand, Trump's victory raised concerns about potential new trade barriers with China. China, the largest importer of US soybeans, accounts for approximately 40% of total US exports. Despite this increase, prices are expected to decline in the medium term due to ample supply. Argentina's soybean production forecast for 24-25 has been raised to 52 million metric tons, with planted area projected to grow by 7%. In Brazil, planting is progressing with almost 53% of the expected area sown. Brazilian soybean acreage for the 24-25 season is projected to rise by 3% to 117 million acres. Moving to the shipping industry. Containerized freight index marginally increased by 30 points. Spot rates ex-China climbed again for almost all destinations, related to the ongoing Christmas rush. Market analysts expect this trend to continue for a couple of weeks more, but perhaps the increase will not be dramatic. The Baltic Dry Index rebounded by 120 points last week amid steady activity in Capesize segment. Capesize index climbed the most by 17%, supported by robust demand and active trading in both basins. Consistent activity from miners, combined with weather-related delays, fueled rate increases. Activity in other segments was still meager, so Panamax, Ultra and Supermax and Handysize indices dropped more or less. To sum up, last week deepened the bearish sentiment in nitrogen and especially in urea market. However, ideas of sellers and buyers seem to come closer, so the price bottom is close perhaps. The general bearish trend only slightly affected AmSul segment because tight supply both in Europe and in China kept prices from sliding. Phosphates demand remains strong in India, but only there, while other regions are out of purchasing season. Nomination of Ethiopian tender started with Chinese volumes that tightened supply and drove Chinese FOB prices marginally up. Colder weather in Europe resulted in gas future prices growth, while in the US colder weather is not expected earlier than December this year, so gas future price even dropped a bit. Fresh report from USDA reduced corn and soybean US production projections, which resulted in future prices rebounding. Robust activity in miners in both Asia and Americas weighed Baltic Dry Index growth after a dramatic drop since the beginning of October. And of course, long-awaited US elections finally ended, and the world is entering into the new epoch of the old new president that will change a lot globally and affect fertilizers industry as well, most likely. So let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.